Why use fundamental analysis? Many investors use only the fundamental factors in their analysis of a company, but some people have found that they can get more accurate information by looking at both fundamental and technical factors. The goal is to see whether the current price of stock reflects a value that differs from what fundamental factors and overall market sentiment suggest. There's a chance that an investment opportunity exists if such a difference is detected. Start with the earnings. You should take a broad look at data, but the first item to search for is the company's earnings. That figure is the easiest method to answer a fundamental investing issue. How much money is the company making? And how much money is it capable of making in the future? In other words, earnings are the profits of a business. They may be difficult to calculate, but that's what buying an organization is all about. Investors will be pleased to learn that firms disclose their quarterly results throughout the year. Analysts pay close attention to these announcements, especially for large firms. When a firm reveals that earnings are increasing, the stock price usually rises. If one isn't already present, it may also result in bigger dividends, or even the creation of a dividend in some instances. When earnings fall short of forecasts, the stock can be punished. That means traders sell off their holdings as soon as they appear to be overly priced, resulting in a price decline. The tools of fundamental analysis. Earnings are important, but they don't tell you much on their own. Earnings alone do not indicate how well the company is priced in the market. To begin to create a picture of how the company is valued, you'll need to look at additional fundamentals analysis tool. Fundamental analysis is a method of examining a company's financial data to determine if it is overvalued or undervalued. The most well-known tools focus on earnings, growth, and value in the market. These are just some of the elements you'll want to consider. Earnings per share, EPS. On its own, neither earnings nor the number of shares can provide much information about a firm. When you combine them, though, you get one of the most frequently used measurements for analysis. The EPS ratio is one of the most popular analyses because it reveals how much profit is assigned to each share of stock, net income after preferred dividends, divided by the number of common shares that exist in the market. Price to earnings ratio, PE. The figure shows the ratio of a company's current share price to its per share earnings. Price to sales ratio, PS. The PS ratio of a company is the value of the stock as compared to its revenues. It's sometimes called the PSR revenue multiple or sales multiple. Projected earnings growth, PEG. PEG tells how fast the company's earnings will grow for 1 year. Price to book ratio, PB. The PB is also called the price to equity ratio. It is found by dividing the most recent closing price of a stock by the last quarter's book value per share. Book value is how much money it would take to buy all of your assets or what you paid for them minus how much they lost through depreciation. Return on equity. To find a company's return on equity, divide its net income by shareholders' equity. This is sometimes called the return on net worth. Dividend payout ratio. This compares how much money the company pays out to the company's total net income. It also accounts for any money that is not paid out but is saved instead. Dividend yield. The yearly dividend total compared to the stock price is this figure. It's expressed as a percentage. Divide 1 year payments per share by the worth of a share to calculate the discount rate. Understanding fundamental analysis and employing them in your due diligence is a very important skill set. Let us know what other techniques you use in the comments, and don't forget to subscribe for weekly consulting tips made simple.